Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And welcome to the Accunet Mortgage and Realty Show. Steve Kettler taking the day off. I'm Libby Collins, along with Accunet Mortgage and Accunet Realty Advisors owner Brian Wickert and licensed millennial loan consultant David Wickert. Now, during the show, if you have any questions or you want to comment, you can reach us by calling or texting the Accunet Mortgage talk and text line at 414-799-1620. So, Brian, David, good morning. It's a beautiful day out there.
Absolutely, and welcome to our show. I've admired your work on the Saturday talk shows, and I don't know how you negotiated for this promotion to come on to our Sunday talk show, but welcome to the Accunet Mortgage and Realty Show.
Seriously, I cannot tell you how excited I am. And you have some really interesting topics today because so many of us, you know, whether we're looking at buying a new home, maybe we're thinking of switching things up. Some people are thinking of downsizing or even looking to get that vacation or weekend home up north. It's a great time to really be shopping, isn't it?
For sure. Interest rates are low. And right now we're having what I'm calling the second wave of the home buying season. You know, you've got the spring wave. And now that school's out, you've got the summer wave. And what that means is we've got more people listing their homes. A lot of people wait until after school's out before they list their home for sale. So we've got a little uptick in inventory. Also, a lot of people have already bought homes. And some others...
If you already bought a home, you're not competing against those people anymore.
Right.
They already have what they need.
That's right. And then others have kind of gotten tired because it was really competitive in the spring. So a little more inventory, a little fewer buyers, that's a good recipe to be out there as a buyer. Still competitive, especially for the nice homes, but a good time to be out there because of the increased inventory. And, you know, because of all the reality shows out there on HGTV, do you watch any of those Flip My House and this sort of thing, Libby?
I love those shows.
Okay.
I'm like addicted to the $1 million listing things, too. I guess I have pricey taste.
Well, that's if you're going to have any taste at all.
For expediency. Remodel my house in 30 minutes.
Oh, yeah, I like that one. So a lot of people are attracted, I think, because of those shows that, hey, I'm going to buy a foreclosed home. And I'm going to get a great deal on it. And then I'm going to do just a couple of things to it, and it's going to be worth a gazillion more when I'm done. All right, but we have a honest-to-goodness story from the front lines of mortgage lending this very week where our buyer found himself at a place buying a foreclosed home. And let's clarify this, David and Libby. Some people think, oh, I want to buy a foreclosed home at the sheriff's auction. That is really, really hard to do because you have to prove you have the money within 10 days. Right. Okay, so you aren't going to get a loan on that house in 10 days. You just can't get the appraisal done that fast, blah, blah, blah. Even if you're rock solid pre-approved, you're not going to be able to prove to the sheriff that I got the money. You either got to have a line of credit on some other property or cash to actually buy the house at the foreclosure sale on the sheriff's steps, courthouse steps.
And the other people who are there bidding on that same property as well.
That's right. The other time when you can buy a distressed property is before it's foreclosed on. That's called a short sale. This is where the homeowner still owns the property, but now they're like, hey, I'm upside down on this mortgage. You know, I owe $400,000 and I can only get $360 for the house. And that's difficult too, by the way, because then you're dealing with that seller's bank to get permission for the short sale, and that can draw out for weeks and weeks and sometimes months. Okay, so that's not too much fun. And then what this buyer was doing was buying it from the bank who had already succeeded in foreclosing, kicking out the old owner. Now the bank owns it. So that's the most typical thing we see. But here's the problem. There's like a gazillion page document that says you're buying this as is. Okay, so anything you turn up on the inspection, it's your problem. And so what came to light at the very end of the process was this municipality that the property was in required that if the property was on a private well previously, upon changing hands, it had to be connected to the municipal water system. Well, they did. Oh, that was like a surprise. They didn't know that. Oh, guess how much it was going to cost? 9,000 American dollars.
Wow.
Okay. But because of the as-is clause,
They're not going to do it.
too bad, so sad, Mr. Buyer, right? It's your problem because you bought it as is, and all the due diligence was on you, Mr. Buyer, to figure all this out before you decided to write the offer, and he didn't. All right, so now he comes to us late in the week and says, can you deny my loan? All right, when we come back from this break, we're going to talk about what we were able to do, because it wasn't easy to find a way to deny this guy's loan, and we figured it out. I'll give you the answer when we come back.
Looking forward to it with Brian Wickert and also David Wickert. It is the Accunet Mortgage and Realty Show on 620 WTMJ.
Home buying advice from the guys who know it best. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
WTMJ's Classic Free Ride makes one final pit stop before it pulls into Summerfest, and that's tomorrow in Waukesha. Join John McCure and Wisconsin's Afternoon News as they broadcast live from 3 till 6 at Swimming Pool Services. You can register to win the 1968 Valenti Oldsmobile 442 convertible and tickets to see Red Hot Chili Peppers perform at the Big Gig. That's tomorrow from 3 till 6 at Swimming Pool Services on Jericho Court in Waukesha. It's WTMJ's Classic Free Ride, sponsored by New Mail Medical in Tosa and Summerfest. We're here with Brian and David Wickert, and quite a story about that foreclosure and doing due diligence.
Right. So when you buy a foreclosed property, a lot of times the bank will make you sign an, quote, as-is addendum, which is a 4-page document that says you are buying this house as is. We don't really know anything about it because we haven't lived there. So it's on you to do all the inspections and due diligence. And in this particular case, the buyer found out late in the game that that the property needed to be hooked up to the city's municipal water source. It had a private well. And that because he signed the as-is amendment, he was going to get stuck paying the $9,000 to do it. So it's like he wanted out. Well, there's usually 3 ways you can get out of your offer to purchase. One is if the house appraises low. That didn't happen. It did appraise out. This is a fairly expensive home, over $500,000. So it did appraise out about $20,000 more than the agreed upon purchase price, thereabouts. Another one is on inspection. Hey, I inspected the house and I found a bunch of problems, so I want to kill the deal. Mm-hmm. Well, in this case, because he signed the as-is addendum, he couldn't get out of it because of the inspection. And so the third thing is financing. Oh, I couldn't buy this house because I couldn't get the loan approved. Well, this guy had great credit. He made enough money. He had enough for the down payment, even with the extra $9,000 that he would needed. And then finally, I slapped myself on the forehead. I was working with one of our senior loan consultants on this, and said, well, wait a minute. We can't close on this loan because one of the representations and warranties that Accunet Mortgage or any other lender has to make, in this case to the jumbo investor who's buying the loan from Accunet, is that the property meets all state, local, and municipal codes and ordinances. Shazam! This one didn't meet the ordinance that says when you sell a property, it has to be hooked up to the municipal water source. So we were able to deny the loan because the property itself did not conform to local ordinances. And that's how we're helping him get his denial. You know, it's not so many times. Usually mortgage companies, Libby, are in the business of approving loans to help customers. Every once in a while, like in this case, we're asked, could you pretty please give me a denial? Because I need to get out of my offer to purchase contract. So that's the end of that story.
I was going to say, so there must be relief on his side, and you wonder, is he going to continue to look for foreclosed properties?
I'm gonna put my money on no. I think that once a person has been down this road, or as we were talking, that short sale road. Oh, I'm gonna get a bargain and get this property on a short sale from the distressed seller, and then that drags out for 3 months. They kind of get a bad taste in their mouth and go, I don't want to do that.
Not as
All
easy
right,
as
when we come back.
Yeah, not as easy as it looks on TV.
No, not exactly. I think they take out, they have the ability to edit on TV. They get that waiting part and frustration part and scary part. All right, so when we come back from this next break, I'm going to tell you a story about a rock-solid pre-approved buyer who has been out there shopping for homes and has been not winning because of three little letters. Can you think of what those three little letters are? Think about that during this break, and we'll give you the answer when we come back.
Along with Brian and David Wickert from Accunet Realty Advisors and Accunet Mortgage. I'm Libby Collins for Steve Kettler on 620 WTMJ.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
The 50th Big Gig begins Wednesday. What are the top three acts that VP of Entertainment Bob Babish can't wait to see perform? Well, you'll find out that answer and get your full Summerfest preview during our Summerfest Soundcheck at 8 tonight, right here on WTMJ. We're here with Brian and Dave Wickert. I've been racking my brain, Brian, trying to figure out what those three little letters are.
All right. If you're in the mortgage or real estate business, anybody out there is going to know them. David, you want to give us the answer?
FHA.
FHA. An FHA loan, Federal Housing Administration. And so these particular folks have okay credit, not great credit.
Middle of the pack.
So one of the borrowers in mortgage lending, we're like the old Olympic judges, we're curmudgeons. We take the middle of the, we throw out the high and the low score.
French judge.
Yeah, they throw out the French and the Russian judge. And we go with the middle score, and then because mortgage lenders always take the dimmest view possible of any situation to be conservative, we take the lower of the two borrowers' middle scores. All right, so in this case, one borrower had a 685 score, which isn't terrible, and the other borrower had a 720, but we have to price the loan off the 685 because we need both of their incomes. And so what that meant for them was that going FHA, because FHA does not differentiate the cost of the FHA mortgage insurance or the interest rate based on the credit score. Whereas if you go with a regular 30-year fixed-rate loan that's going to get bundled up and sold to either Fannie Mae or Freddie Mac, there is a big difference between a 760 credit score when it comes to mortgage insurance and also the pricing of the loan. So we're talking like a $200 a month difference.
Whoa.
Okay, between the 3% down on a conventional loan, meaning a Fannie Mae loan, and 3.5% is the minimum down payment on an FHA loan. So these people said, and I explained to them up front, hey, sellers don't like FHA pre-approvals. They don't like FHA loans. And why is that, David?
Because the appraisals can be a little bit stickier.
Yep.
On things like handrails or, paint that's chipping, just
correct.
Some
FHA loans FHA appraisals are famous in the mortgage and real estate industries for being pickier because of chipping paint, chipping or peeling paint. And the reason there is a fear and a well-founded fear for lead poisoning. Okay, so a lot of times FHA loans, might be on an older home that was built after 1978 when lead paint became illegal. So that's an issue. And then safety issues, like if you have stairs going down to the basement, you don't have a handrail. FHA, you're going to have to put in a handrail. Or like at your sister's house, David, where they don't have a railing going from the sidewalk up the 6 steps to their yard.
Sure.
If they had got an FHA loan, you got to put in a hand railing. So nothing terrible major, but these people have put in offers on about 3 loans. Homes, and have lost out every time. And they have a really good real estate agent because I connected them with one. Remember, that's something that Accunet Realty Advisors does. We match buyers with real estate agents, either on the sell side or the buy side. But they have struck out numerous times. On this last one, the real estate agent even pointed out to the listing agent, this property doesn't have anything to be concerned about.
Right.
It has no peeling paint. It has no loose or missing handrails. What does it matter? And yet the listing agent said, nope, I've been burned on FHA. I'm not going to recommend this offer to the seller. Okay.
So the way that we're going to fix this, or we are fixing it, is we just negotiated some new PMI insurance rates with one of our vendors. And so now, even though we have the 685 credit score, we can give the borrower a loan with no monthly PMI, because remember, the monthly PMI is really expensive. Mm-hmm. We can do what I call our invisible PMI. It's where we bake the cost of the PMI into the rate. And check this out. Even though we have to charge them 5.125%, which sounds horrible when I say that, right? A 5 handle, oh my goodness, terrible.
Yeah.
On the interest rate, it has no monthly PMI, so the payment per month is only $24 more than the FHA loan that has a much sweeter sounding interest rate of 3.625. Mm-hmm. But FHA mortgage insurance, Libby, is really expensive. It's almost the equivalent of a full percentage on top of the interest rate because the loan's being guaranteed by the federal government. So bottom line is we came up with a new scenario for them based on this newly negotiated PMI rates that we have that's going to allow them to write their next offer without those scary 3 letters, FHA. They're going to be able to write it as a normal, regular, run-of-the-mill, boring 30-year fixed-rate loan. And that's how we're going to help that young couple become first-time homebuyers. All right, after the news here, which we're coming right up on, we're going to talk about how to buy a home in retirement. And I've got a terrific, honest-to-goodness, real-life story from this past week on a retired couple looking to buy a $400,000 home in Florida on minimal income. We'll tell you how we solved that puzzle when we come back.
Important home buying questions and answers you can count on. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And welcome back. I'm Libby Collins in for Steve Kettler, along with Brian and David Wickert. And you were going to share with us, Brian, a story about a couple buying a home in Florida.
I'm going to jump the shark on you here because I think this is a larger conversation for folks who call in during the week who are worried, hey, can I buy a house or get a mortgage when I'm retired?
And the answer is probably.
Yeah.
It depends on several things, but this is a good illustrative story for that very topic. So I got the call from the couple's financial advisor, and the story is that they have an accepted offer on a $400,000 home in Florida. And the couple was pre-approved for a $200,000 loan by a local Florida lender at a rate of, are you ready, 4.375 with no points. And they were guaranteeing, by the way, that nobody could beat their rates. So the reason they were only approved for a $200,000 loan, my guess is because on their tax returns, they have pension income from the husband, Social Security income, and then his required minimum distributions from his IRA because he is over 70 and a half years old, so he's required to take out a minimum amount of money. And based on that income showing on the last year's tax return, they could qualify for $200,000, but not anymore. The big problem for the financial advisor and for the borrowers, and I'm going to ask David this question. You're a former financial advisor and Series 7 securities license holder. So I'm going to ask you what the big problem is if you most of their money, by the way, is in qualified, meaning retirement funds like IRAs and the like. Oh, wait, before I ask you, I'm going to ask Libby. Libby, what happens if you take $200,000 out of an IRA in order to buy a house in any state?
Depending on how much money you start out with in your IRA, it could be a good thing or a bad thing, especially if you only have $205,000 in your IRA.
Okay. Yeah, you're left with no more money to supplement your income. But what is the thing that was weighing on the financial advisor's mind?
It wasn't death; it was taxes.
That's right. It wasn't death; it was taxes. And explain more about that, David.
The way that Uncle Sam allows you to sock away money into a qualified retirement account is they say you don't have to pay taxes on that now, but someday down the road when you start to take money out of that account, I'd like my chunk, please. Right. And so that IRA, or for folks who have a plan at work, a 401k, for example, it's pre-tax money, but Uncle Sam's going to come calling for his cut when you take that money out. And so the financial advisor is like, great, you can take out $200,000, but you're going to have to give Uncle Sam like $40,000. It depends what their
it's going to
tax
put
bracket
them,
is.
and so let me clarify it another way. If that $200,000 came out of an IRA or an annuity in 1 year, it becomes income.
Yeah.
Instantly for that year. So even if
suddenly you made $200,000 this year,
right? So instead of like last year, where their taxable income might have been $40,000, which puts them in the lowest tax bracket of 10%,
it's $250,000.
Now you all of a sudden make $240,000, and you got to pay tax at the 35% level, which would be horrible.
Yikes!
So it was a tax problem that was weighing on the mind.
But they want the house.
But they want the house.
Okay.
And the mission, though, for I wish I had the Mission Impossible music going right now. Scott, I should have warned you. Dum, 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 dum. For Accunet Mortgage was, how could we lend them more money so that they could minimize their down payment? Well, the first step on that journey was that I could get them approved, not pre-approved anymore because they had an accepted offer.
Mm-hmm.
I could get them approved for a $300,000 30-year fixed-rate loan by having the husband in this case start to take out $4,000 a month from his IRA instead of the $1,500.
Because that's income.
Because that's income that I can then use to qualify. So we do this time and time again, is we work with the borrower and their financial advisor to say, okay, you're buying this house on September 1st. On August 1st, we're going to have you take out a little bit more than normal, and we're going to have a letter from the financial advisor that says you're going to start taking monthly distributions at the pace of $4,000 a month starting August 1st. And then we also have to prove that you have enough money in the IRA to last for at least 3 years at that $4,000 withdrawal pace. And voila, we now have income that we can use to qualify. So now we just took, we were able to allow them to keep $100,000 in their investments.
That's awesome.
But wait, it gets even better, and I'll tell you that part of the story when we come back.
And you're listening to the Accunet Mortgage Show. And, of course, if you have some questions for Brian and for Dave, you can get through right now by either calling or texting the Accunet Mortgage talk and text line at 414-799-1620 right here on WTMJ.
Expert advice on buying a home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Domestic violence is a global issue. In Milwaukee, the Sojourner Family Peace Center aims to help both victims and their abusers. Jane Mattiner goes one-on-one with the president and CEO of this important area service during WTMJ's Conversations, coming up at 11:07 this morning. We're here with Brian and David Wickert. And, Brian, you were talking here before we took the break about this couple in Florida who were taking money out of their IRA, and they would increase the amount they were taking out monthly. But what I'm wondering is, after those 3 years, can the couple go back and reduce their IRA monthly distribution from $4,000 back to either $1,000 or $2,000 or whatever makes sense to them?
All right, so I'm gonna jump in on that answer.
That's David talking there.
Okay, so the 3-year piece is just to make sure that there's enough money in there that they could, if they chose to, continue to make those withdrawals. And the answer that any of our loan consultants will give is, after you close on the purchase of your Florida home, there is nothing that requires you to continue to take those distributions.
There you go. So it doesn't have to be 3 years. It has to be maybe 2 or 3 months. So these folks are going to, take out their first distribution in August. We're going to demonstrate that they have the ability to keep doing that and the intent.
They could if they want, right?
They intend to do this. And then their loan closes on September 1st. So I've asked them to at least take their October 1st distribution as well. And then if they change their mind, this is America, Libby. They aren't obligated to keep doing it for 3 years. We're just showing that was their intention up front. Is that? I think that's still ethical because they did intend to.
I think it's a great concept. We've got a call coming in with a similar question to that, Brian. Darren in Palmyra has a question for you about taking money out of their 401k to finance a mortgage. Darren, go ahead.
Hi, guys. Thank you very much, first of all. And my father recently passed away, and now my mother is left with 2 properties. And I assume once they find out about his passing, she's going to have to refinance them in her name. He had, Social Security and a small pension, but the bulk of their money was in, a 401k. And I'm just kind of wondering how that's going to work now with her not being able to show as much money. On a refinance like that, is that any different? Is she going to have to prove higher income, or like you were saying, just start drawing more out of her 401k to prove that? I don't know if I'm making sense, because I don't really.
You're making total sense, Darren. First of all, I'm sorry to hear about your dad's passing away. That's tough, no matter how old or young the person might be. But I have good news. Your mother does not need to refinance those mortgages. All right.
Really?
Yeah.
Okay.
So she can just keep on making the payment. Now, if she wants to, we can take a look at that if there's an opportunity for her to save money somehow. But she is not obligated to refinance those loans. David?
So long as she is currently on the mortgage.
Yep, everything's up to date, always has been, and
yeah.
Yeah.
She may, she's obviously going to sell one of the properties, hopefully, but until that happens, I just didn't know if they would come after and say, hey, now this has to be only in your name. But
right. Now she will want to do some maneuvering. So if she gets a copy of the death certificate, when she goes to sell that first property, you're going to want to have it retitled so that it's only in her name, because she's going to have to sign the offer and the deed by herself. So however what county is that property in that she's going to sell?
That is Waukesha County.
Okay, beautiful Waukesha County. So when that happens, and depending on how you sell it, we are affiliated with Lakefront Title. So you can just give me a call. My phone number is on the homepage of our website, and I can get you hooked up with Lakefront Title to take care of both the title insurance for selling that home and for taking care of the appropriate recording of the deed so that she can sign it as a single person, which she now is. So thanks for listening to the show, Darren, and for calling in. Really appreciate it. All right, when we come back after this break, we're going to finish up the story on the Florida couple, because remember, we did one good thing, which was to reduce the amount of down payment that they had to take and pay taxes on out of their IRA. Remember, they were going to have to take $200,000 out under the plan with the Florida lender. We got them to $300,000 on our first kick at the can, but I did even a better job than that, and I'm going to tell you exactly what we did when we come back.
Can't wait to hear what happened with Brian and David Wickert. And you're listening to the Accunet Mortgage and Realty Show on 620 WTMJ.
Getting you through the home buying process. Welcome back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And we're back with Brian and Dave. I'm Libby Collins for Steve Kettler. I'm just sitting here wondering what that happy ending is. I envision this couple sitting by the pool while we're freezing in January and sipping their iced teas.
Yes.
Yeah. So what happened?
All right, so this is 2 other little words that are good, and the answer is our borrower happens to be a veteran. And so one question that all mortgage lenders are supposed to ask borrowers, and I did, are you a veteran? And he said, yes. And I went, you might qualify for a VA loan. And here's the cool thing about a VA loan, and this is what we're going to pursue now after I kind of did all the homework on it. So first of all, remember that bank or lender that approved him in Florida said 4.375 with no points, and we'll beat anybody. Well, I was able to lock him in on the conforming regular 30-year fixed rate loan at a rate of 3.99, not only with no points but also paying $1,160 of their closing costs for them. So we beat him there. But then on the VA loan, because that's guaranteed by the government, the rate that I'm able to get them now at a $360,000 mortgage, so on a $400,000 purchase price, they're only putting $40,000 down. Now they're not taking $100,000 out of their stockpile of wealth, which, by the way, the other downfall, not only are the income taxes you would have to pay, but as you started to point out, Libby, I think the crux of your observation was now that is money is not there anymore to grow.
Exactly.
And give you income in your retirement. So I did the math this morning before the show, and so now by going to 360,000, just $40,000 down, the total difference in closing costs, because you do have to pay a VA funding fee equal to 1.25% of the loan amount, but VA loans are, since they're guaranteed, they're more lucrative. We're able to pay $4,000 of their closing costs at a rate of 3.625.
Wow.
Isn't that cool? So the nominal difference between the two loans, the $399 with $100,000 down, and the $40,000 down in the VA loan, in terms of upfront closing costs, is only about $2,400.
I mean that is such a savings.
Right, but you get to keep another $60,000 in your retirement account. And then I started doing the math. If they got on that $60,000, if they got 5, 6, or 7%, which this investment advisor had been routinely achieving for this couple, that's like between $2,900 and $4,000 a year, every year, of additional income generation for them, whether they take it out or not. That more than covers the upfront costs, blah, 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 tax savings. We are hitting a home run, a grand slam for these particular people because we're good at what we do. David was just saying while we were on the break, when you're in the mortgage business, if you want to do a good job, David, what do you have to do?
I was just saying, as we've trained up new loan consultants, you're not just becoming an expert or at least knowledgeable in mortgage. You also have to have some expertise in taxes and financial products and estate planning and title and real estate. It's the whole picture.
That's what we did.
To try to do what you did with this couple, which was look at it from all angles.
Which we got to give credit to the financial advisor who has introduced us to a lot of his clients. They're experts on the asset side, and we're not expert at taxes or estate planning. We just know how we fit in.
Right.
And how...
Yeah, I'm not going to do your taxes.
No, we're not going to do that. But understanding the implications of these things, that's why a lot of financial advisors like working with us, because we get it. So if you're a financial advisor out there, we'd love to work with you and your clients because we kind of have that same holistic perspective that good financial advisors have. And, homeowners are just homeowners or home buyers, and a lot of them think, hey, more down payment is better.
Yeah, well, they just like the kitchen. And then the money is the thing that comes second.
The money is the tool. But luckily, these folks really trust their financial advisor, and he was able to bring us in. And I just think this is really a good, happy ending, as you put it, Libby, for this couple.
Well, Brian, what I was going to say is I know listeners can reach you at Accunet.com, but you're the kind of people that you want to talk to people and find out all of these little bits of information that can really help them. So is there a way where listeners can reach out to you more directly than the website?
Sure. Our phone number is 262-781-1100. 781-1100, area code 262. But the way a lot of people get started in connecting with us is by clicking on the blue button at Accunet.com, because we have a couple of different really short forms that are easy for people to fill out that they can do 24 hours a day, 7 days a week. Like, hey, here's my need. And if it's really, really complicated, you might end up talking to me. If it's, plain vanilla, then you probably don't need to talk to me. And I can't talk to everybody, which is okay. We've got a lot of smart cookies like David and our other staff available all the time up until 7 o'clock every evening. And so there you have it. Thanks for subbing, Libby. You did a great job. We appreciate it. And we'll be back here at the same time next week.
And thank you to Brian and David Wickert. I'm Libby Collins for Steve Kettler.